if you look at global economy, inflation is slowly and steadily coming down across most parts of the world, albeit it is not falling at the speed which central bankers would like. Within world, while growth has started slowing down a little bit as impact of interest rates are felt, in US and Europe, from bottom, things seems to be moving up, especially on manufacturing. Will it be fair to say that we are looking at a soft landing of economy, growth not going into recession and remaining positive, and inflation remaining little above the target level? Looks like central bankers have achieved that impossible. As growth has started slowing down, there are central banks which have started cutting interest rates. Swiss National Bank, Bank of China, both cut interest rates. And slowly and steadily, the world is believing that we are moving from tightening to easing cycle. China continues to remain a very, very attractive market from a valuation point of view. For almost 3 decades, Chinese stocks have not delivered any return to investors. And many Chinese stocks are having dividend yield, which is very, very high compared to rest of the world. Will people start investing into China? There are legendary investors like Ray Dalio of Bridgewater, who is now saying that Chinese stock, Chinese equity is a good time to invest. Coming to US economy, central bank US Fed has done a great job there. They have raised interest rates at the fastest pace to lower inflation. And they have taken out liquidity in a very, very calibrated manner to ensure that growth does not go into recession. The fourth quarter US GDP growth for December 23 came ahead of expectation at 3.4%. Obviously, it does not give any room to US Fed to cut interest rates. The strong economy along with ample liquidity resulted into US market outperforming global markets, even though just 7 or 8 stocks led this entire rally. The broad households financial asset allocation in US is tilted towards equity, unlike in India, which is tilted towards bank deposits and insurance and pension fund. Maybe this kind of higher allocation of household savings into equity is also keeping US markets at high level. There is always a side effect for a medicine, and to some extent, US growth is driven by record accumulation of debt. They took about 200 years plus for first $10 trillion of debt. Now they are accumulating $1 trillion of debt in about 100 days. US debt has now crossed $35 trillion, or roughly about 125% of GDP. The worry for US is not only the size of debt, but also the funding of the debt. They have typically funded in recent times their debt through short-term borrowing rather than long-term borrowing. As interest rates have gone up, their reliance on short-term funding has increased, which gives them slightly cheaper funding. You can see how red bar dominates US chart, whereas they are practically missing in all other developed nations like Canada, Europe, Japan, and UK. The other side effect of American growth is K-shaped recovery. Many Americans are today doing part-time jobs or double jobs in order to sustain themselves. As per one research, most of the jobs created in post-pandemic era is either government jobs or part-time jobs and not full-time jobs. In all this confusion, Fed is behaving like a Trimurti, Brahma, Vishnu, Mahesh. One Fed governor says rate cuts may not happen. Other one says that no, one rate cut can happen. And the third one around the same time says, oh, don't worry, we are on course to get 3 rate cuts. If Fed doesn't know what's going to happen in their policy, how are markets expected to know? The real worry why Fed is giving differentiated commentary is bounce back in inflation like in the 70s. In the 70s, Arthur Burns, the Fed chairman, was quick to pronounce victory on inflation and started cutting rates early. Eventually, that resulted into spike in inflation and resignation of Arthur Burns. Today, no one remembers Arthur Burns positively because inflation had shot through the roof in his tenure. Coming to Indian economy, we are truly oasis in the desert. All the data points of Indian economy continues to remain fairly robust and positive. Our central government and state government capex continue to remain healthy. The government this year will be investing about 10 lakh crore at central level in infrastructure spending. The bank credit growth, albeit it is coming down from 20% plus level, but it still remains healthy at 16-18% band. The capacity utilization is about 75%. It's stagnating in this band for some time. But if PMI manufacturing is a lead indicator, then we should be looking at enhancement in capacity utilization in the days to come. The part of the capacity utilization is driven by India's electronic exports led by mobile phones. The opportunity is large, and countries like Vietnam, Mexico has captured far more. But within whatever limited window we have been increasing our electronic exports, albeit the pace could be even more. On the defense side, for the first time, India will be crossing 20,000 crore worth of defense exports. Such kind of exports is increasing India's capacity utilization. The railway freight volume is about 5% increase, led by coal and cement and other goods. There was drop in food grains, probably because of better crop across India. The domestic economic activity remains at a reasonably solid level. The e-way bill generation and GST collection also gives confidence that economic activity seems to be moving in right direction. The PMI continues to remain in an expanding mode, and in fact, Indian PMIs today is one of the highest in the world. The balance of payment is likely to be in surplus for FY 2025 as exports have gone up, imports have come down, and services exports led by Global Capability Center is moving in right direction. FX reserves consequently with balance of payment surplus are back to $640 billion, near all-time high. As India is growing, there is rapid increase in energy demand. We believe India may face some power cuts in this summer as our power plants are running at full capacity utilization. Oil prices have risen in last month or so, partly by Israel-Hamas war and partly by oil production cuts led by Saudi and Russia. Hopefully, they will increase production at some point of time, as they will prefer oil prices to remain in a band rather than going into triple digit. So oil prices have risen in the recent time because of war action in Middle East and also production cut. The job creation or employment creation is relatively subdued in this current phase. Hopefully, post-election, it should pick up. The rural recovery remains subdued. That's one of the reasons why consumer FMCG companies' results are not up to expectations. In India, also like US, we are seeing K-shaped recovery. Mobile phones are selling more than consumer staples. SUVs are selling more than entry-level vehicles. Big houses are selling faster than smaller houses. The RBI increased weights on unsecured loans. Impact of that on consumption is something which is not yet ascertained. But one does believe that as retail loan growth starts slowing down because of RBI's action, there will be impact on automobile sales and real estate sales. As of today, consumer sentiment, especially in rural India, seems to be subdued. Hopefully, a good monsoon expected this season should support rural sentiments. One thing which is working well in favor of India, especially from a stock market point of view, is when India starts doing more investments. That's the phase when our markets do well. Post 2020, led by government, India's investment capex is rising, and partly that is reflected in our stock markets doing well. There is expectation that private sector investment will revive to support government investment. One, enough bank credit is available. Second, in core items like cement, steel, power, now demand supply gap is lower and hence capacity buildup should start. And more importantly, corporates are deleveraged and sitting on fair amount of liquidity. Expectation is that from current 30% plus gross capital formation, we should be moving to little higher towards the 40% over a period of time. This phase is something like between 2003 to 2008. In 2003 to 2008, capex led was driven by easy bank credit availability. But this time, credit growth is driven against tight governance expectations. Coming to equity market, this market is 1-2 market. The large caps have delivered half the return of small and mid cap, and micro caps have delivered probably 3 times return than large cap. A lot of this is expansion of PE multiple rather than profit growth. In Nifty, profit growth at 17% is higher than PE growth at 14%. But in micro caps, while their earnings growth is similar to large cap, the P multiple has expanded 4 times more. And that's why they have delivered 3 times more return than large cap. The return on equity of companies continue to remain at a higher level. Leverage continues to remain at a lower level. So one can say this market rally is based on strong corporate fundamentals. Street expects about 1148 earning per share for Nifty 50 in FY25 and about 1029 rupees kind of earning per share for NSE 500. This profit growth is likely to be driven by materials, industrials, pharma, and financials, whereas oil and gas, utilities, consumer staple, and IT will be relatively subdued. The domestic focus sectors are likely to deliver higher earnings growth in the years to come compared to broad market. Correspondingly, our weight in MSCI emerging market index has continued to rise. And if MSCI is kind enough in September 24 to increase HDFC Bank's weightage from 50% to 100%, this weightage can go up by further percentage point. For FPIs, the dilemma remains whether they should buy Sundar market like India, which has delivered return every year, but is available expensively, or they should go and buy Sasta market like Russia, Turkey, China, which are available at 1/3 to 1/8 valuation of India. Sundar kharide ya Sasta kharide. If we look at our peers in terms of profit growth and return on equity, India doesn't look outlier like on the P ratio side. On a price to earnings growth basis, India is still relatively in the middle tier rather than top tier from a valuation point of view. FPIs, after heavy selling in month of September, October, turned buyers in December, turned sellers again in Jan, but Feb and March, they have again turned buyer. And I believe April numbers are also positive. They are net buyers. You would have seen some domestic selling in market in last couple of days. That's actually arbitrage fund selling, not necessarily active mutual fund selling. The small and mid cap is on a fire. The top 10 stocks as a percentage of BSE 500 has come down by almost half, from 40% to 26%. The tail is wagging the dog. We can say that. Even Nifty, from 71% to BSE 500 market cap, is now at 56%. The small and mid cap is now contributing about 37% of total market cap. Generally, we have seen when small and mid caps are such a large percentage of market cap, then the returns from small and mid cap starts moderating and returns from large caps starts increasing. One frothy area in market is limited floating stock counters. In many stocks, government owns substantially more percentage above minimum public shareholding limit. That restricts free float in the market, and limited amount of buying can pull prices higher significantly. in our opinion, most of these companies will not be able to come to market at this valuation or prices. The market cap to GDP ratio is at all-time high of 132%. It's 50% more than historical average of 80%. But clearly, profit to GDP ratio also remains at about 5%. I was searching for that chart, but probably it's somewhere behind. So our valuations are at all-time high in terms of market cap to GDP ratio, not PE ratio. And our profit to GDP ratio is also near all-time high. And which is why, while market cap to GDP ratio looks higher, it's not an extreme cause of concern. Valuation-wise, mid and small caps are slightly above their historical average. Large caps at 5% premium is around their historical average. The earnings growth in small and mid cap is likely to be higher than large cap, and which is why one can take a call to stay invested in small and mid cap. Our suggestion at this point of time, be underweight small cap, equal weight mid cap, and overweight large cap with neutral allocation to equities. Do take out profit from low floating stock counters as those valuations looks unsustainable. In our asset allocation and balance advantage and equity savings fund, we are keeping neutral allocation against a range of about 20 to 80%. In Kotak Balance Advantage Fund, we are at 53%, somewhere in the middle. And in Kotak Multi-Asset Allocation Fund, we are at 54%, again somewhere in the middle. In our opinion, market today is optimistically pricing in up ki bar 400 par, Fed cutting rates by three times 75 basis point this year, oil prices remaining between $60 to $80, even though current market price is 90, and consumption recovery pushing on the basis of good monsoon. Since markets are discounting everything optimistically, and if all those events do happen, we'll still see some rise in market. But any of those events not happening as per expectation of market, we might see some correction. What one should be looking at this point of time from an investment point of view? Well, SIPs is Harfan product. It continues to deliver alpha on a rolling return basis across most of our funds. Even in ELSS and hybrid funds, we have been able to generate alpha over a period of time on a rolling return basis. On a point-to-point basis, in small and mid-cap funds, we are underperforming benchmark indices because many of the low floating stock counters we have not gone and invested. We believe over a period of time, those anomalies will get corrected. In our hybrid and other equity funds, we continue to deliver outperformance over benchmark indices. Again, on a SIP basis across these funds, there is mixed portfolio. Small cap, mid cap, SIP has not generated alpha, but other funds, SIP has generated alpha. We are not chasing momentum right now. We should have chased them last year, but we were not brave enough. Now we don't want to compound our error by going into small and mid cap and low floating stock counter, which can give us short-term flip in performance, but long-term pain of illiquidity. One fund which has done exceptionally well is Kotak Multi-Cap Fund. It's now about to complete 3 years in next 6 months, and it has consistently delivered alpha over benchmark indices. It delivers exposure to small cap, mid cap, and large cap on a consistent basis. Kotak Equity Opportunity is blend of large and mid cap that again has been delivering reasonable outperformance or alpha over benchmark indices since inception. Kotak Contra Fund also has delivered alpha over benchmark indices over last 1 year, 3 year, and 5 year. In this contra fund, we try to take counter cyclical calls. It sometimes takes time to perform, but over a period of time, the discipline of valuation results into contra funds outperformance over benchmark indices. Kotak Quant Fund was the youngest child of our family. It was launched with combination of men and machine, and it's now about 6 months of launch. We had cooked this fund for 2 years in our laboratory, and 6 months it is in real market. It has delivered alpha since inception of about 24%. It has delivered return more than many of our large cap funds have delivered over 1 year. Obviously, it's a quality plus momentum fund, and it can be classified in high risk, high return category. But this also is one fund where we are experimenting if combination of man and machine can deliver better return. Coming to fixed income market, as I mentioned earlier, US consumer inflation is slowing down, but it is well above 2% range, which is Fed's target level. The treasury yields are rising in last year or so, partly driven by persistency in inflation, and as market starts differing Fed rate cut expectations. The market today is still saying 3 Fed rate cuts of 75 basis points, but probability of rate cut to begin in June 24 has come down. RBI is in a great position. India's growth rate is higher than expectation. Inflation is within the target range, albeit higher than the midpoint. Financial sector is stable. Liquidity is decent. And RBI is in a very, very comfortable position from a policy point of view. In the month of March, they managed liquidity quite nicely by one, bringing in forex intervention, and second, some support from government on last month's spending. The Indian bonds will get included in JP Morgan government bond indices. It will begin from June 24 to March 25. It's expected to bring about $20 to $25 billion to Indian debt market. Ahead of that, about $9 billion worth of buying has happened in Indian bonds. The GDP continues to remain robust for FY25. RBI's recent monetary policy has projected 7% GDP growth, one of the highest for major economy in FY25. Our inflation continues to remain within RBI's target range, and next year's projection is roughly about 4.5 percentage point. We believe this is time to accumulate duration on a 12 to 18 month view. The bond inflows from debt investors, the Fed rate cut, and potential RBI rate cut will happen over the next 18 months. And hence duration or the longest maturity will be a preferred trade. We do expect volatility in the 10-year yield in the near term. As Fed's rate cut gets deferred, there will be some spike in 10-year yield in India, and that will be great opportunity to lock in duration. While in the near term, yields may fluctuate, over longer term, we expect 7% handle to change to 6% between next 12 to 18 months. One way to sell debt funds to retail investors, if you look at fixed deposit rate, a 1-year FD is about 575. ये क्या लिखा है? So today 1-year FD might be available at 6.5-7%. This 575 number is an error. This might have been taken from some bank FD's rate card on the website, which they may not follow. But certainly 3-year, 5-year, 10-year FD rates are far lower than 1-year rates. On the other hand, if you go into debt fund, the 1-year, 3-year, 5-year, 7-year, 10-year rates are upward sloping marginally. And hence you will be able to lock into higher interest rates for a longer period of time only in debt fund. You won't be able to do that in bank deposits. On the debt side, a dynamic fund will be appropriate for investment. Our team has done a reasonably good job in managing interest rate volatility to generate high single-digit return in dynamic fund over a long period of time. The other funds which are worth selling to conservative investors looking for fixed income kind of risk-return trade-off is hybrid fund. Kotak Debt Hybrid Fund has about 15 to 25% equity allocation. It delivers about 4 times more upside than downside. And current equity allocation is about 24%. Kotak Equity Savings is an equity fund from a taxation point of view. Allocation to equity ranges from 10 to 50%. Current equity allocation is about 29%. And it has about 3 times higher upside to downside ratio. Current equity allocation is 34%. Average equity allocation is 29%. Similarly, Kotak Multi-Asset Allocator Fund of Fund Dynamic, which is a non-debt fund, non-equity fund, that has delivered about 48% average equity allocation and 2 times upside downside ratio. Balance Advantage Fund, again, you are familiar with. These are all the products which can be suitable for conservative investors. They will get better risk return trade-off than fixed income or bank deposits. This is Kotak Debt Hybrid Scheme, which is about 15 to 25% equity and 75 to 85% fixed income. You could see it generating about low double-digit return over long period of time and low single-digit alpha generation. Kotak Equity Savings is an equity scheme thanks to its arbitrage position. Again, it has delivered high single-digit, double-digit return. And if you are taking a more than 3-year horizon, then it does generate positive return in excess of 7% most of the times. On gold, we have been bullish since March 2020. Last few days or few weeks have been very good for gold prices. It has crossed 70,000 rupee in local market. We still believe there is longer term trend for gold to move up. The central bank's holding of gold as a percentage of foreign assets is below historical average. And as prices rise, certainly their value will rise. But there could be more gold buying by central bank over a period of time. This could be led by China, which is now buying about 700 tons of gold. If I remember correctly, for last 18 months, they have been consistently buying gold. And gold prices will also get supported as and when US interest rate starts coming down. Normally, gold has secured a century in terms of return when US interest rates have come down. This time also, who knows whether history will repeat or not. But certainly gold prices should get a boost when US interest rate starts moving up. Gold and silver both should be part of your portfolio. Both are looking very good from a technical charts point of view. Both are looking very good from a central bank buying and demand supply point of view. Since gold has rallied to now $2,300 plus, there might be some near-term correction. but definitely they should be part of an investor's portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.